So I wanted to talk about this Goldman Sachs tech sell-off.
Cool.
Look, the idea here is, and this is, I'm really interested to hear what you guys think, is are we in .com 2.0? Are we pre-crash .com 2.0? My initial impulse is no, but I'm wondering what you, what you think. But before we do that, I just want to show you this tweet that's been making the rounds. All right, so this is a chart from Goldman Sachs. It reported that hedge funds are aggressively offloading tech stocks at a rapid rate we haven't seen in years, since like 2017 to 2018. June is already a record month. So this is sell-off from hedge funds. And this is being touted as, a precursor to the floor falling out underneath
So
the
that's
tech market.
notional amount, like total notional amount, or is that
Uh,
relative?
it's the Z-score. It's charting the Z-score, saying that the Z-score is now at negative 2.25.
Got it.
So that this is massive selling that's happening.
Right. So they're measuring a swath of hedge funds, and they're trying to determine the weight of tech sell-offs relative to the other holdings. And if the Z-score is above 2, then it's exceeded 2 standard deviations to the left side of that normal distribution of typical outflows for a sector that the hedge fund is holding. And so in this case, they're basically saying we're seeing a ton more volume of outflows from tech holdings of the hedge funds, and it's exceeded 2 standard deviations to the sell side. That's what I'm reading that as. Does that make sense?
Yeah. What I don't understand here is the sky is fallen attitude for it, because it's sort of like if an institution could be either buying, not buying, or selling, right? So if they're
Right.
selling, then chances are they weren't buying this whole time. And the idea is that, or in my mind, once we've exhausted the selling, well, that's bullish then. If they're selling this aggressively and we're still near all-time highs, that to me is not an indication that the bottom is about to fall out, because the bottom falls out, if I'm correct me if I'm wrong, when we get gamma and the other negative gamma, where prices falling and there's these forced selling that occurs that causes these institutions to have to unload the positions. If they're scaling out of their positions and it's not causing the market to crash, isn't that bullish?
I mean, I would agree, because this particular view of outflows in the market is a summary statistic, right? That doesn't really tell us how much volume is being traded by these hedge funds. We just know that they have really large positions, and all that's true. But also the aggregate positions of the entire US market are not being included in this graph, right? It's just the hedge funds. So if that's true, then I would question whether or not this is just normal rotation from the hedge funds, because that has been a missing component. There's a fair amount of missing rotation within the sectors right now across hedge funds, where they were almost over-indexed on the tech side. So is this just rotating back in and averaging out your holdings so that you're correctly diversified across the sectors, because that's the thesis of your hedge fund, right? So it's possible that this is just interesting timing among the hedge funds to start rotating, but not necessarily a signal, unless we can take a closer look at how that's stacked up in the past. We've seen negative Z-scores on that graph in the past. Has that correlated to downturns in the market?
Yeah, so it hasn't. So that's one of the things that makes me feel like, okay, it's not a really big deal.
Right.
And I have not found the predictiveness accuracy of Goldman Sachs to be something to write home about. Like it's
Good
almost
news,
like,
right?
yeah, you should do the opposite of what they're saying. I'll tell you what it is making me nervous here.
Okay.
Because you see stuff like this and you're like, okay, let's take a look at what's actually going on underlying to the markets, and that to me is the unemployment rate. So
Sure.
if we take a look at the unemployment rate, let me just hide these guys. Okay, so this is the unemployment rate for the U.S., and we're getting a tick up. Tick up. This is a pretty substantial move up from off the bottom, and these oscillations, like we should expect this sort of oscillation. And so if we're moving from a 3.4 unemployment rate, we can expect to get to 5, 6, 7 unemployment rate before this unemployment cycle is over. And if that's the case, well, that does correlate with bottoms in markets, right? So if we put the Nasdaq on there, we'll see here that there's this inverse correlation in a sense that, let me put that on a log chart. We do get these moves down in the stock market when the other one, when the unemployment rate goes up, we do get drawdowns. And so that might be an indication that we are at the top, or it is the local top on the Nasdaq. Do you look at the unemployment rate? Like,
I do.
does that? Yeah.
Yeah, I think one of the other major factors I look at is the Shiller PE as well, which is the overall price to earnings ratio of the S&P 500. And in the past, we've seen some pretty big corrections in markets when we get to really high territories of PE. So at the moment, we're at 32.61 on the price to earnings ratio, which historically you'd want to see that somewhere around 15 to 17. That's where it's averaged out at the bottom. And that's a considered sort of a healthy valuation range for publicly traded companies. The last correction we saw was back in December of 21, when the PE ratio was closer to 40 or 41. And we saw a fairly healthy correction at that point, but then a swift move back upward with the AI craze, right?
That's right.
So I do think that there's strong correlations to some of these economic factors, but then also valuation factors play a role as well. How predictive that is a tough part. I mean, we've seen valuation metrics, like if you go back to the .com boom, the valuations were averaging somewhere around 45 price to earnings. So looking at it today, if we're only at 32 and we feel like there's a whole lot of upside to tech and the AI movement, is there a lot more upside to price to earnings as well? Given that most of the weight of the S&P 500 is tech companies, it's like 25% is the top 15 companies that make up the entire index, then we could see continued upside. But it's so tough to take like one signal and say, oh, that's it. That's the bottom of the market. We need to get out immediately. It's usually a combination of a whole lot of indicators that help you understand market direction.
And I keep thinking that, let's say the unemployment rate does keep rising. I mean, we know that the Fed is just waiting for that number to go up in order to cut rates.
Yeah, well, if they start cutting rates, the belief is that we're already entering a recession at that point. So then, yeah, we will eventually see a market correction.
But
don't
it should
the
be
market
short.
corrections a lot of times come after the first rate cut? I think I
Yeah.
remember looking at data on that.
Yeah, there's a strong correlation to an increase in unemployment, a reduction in rates, and a recession that follows. And the market will usually be the leading indicator of that.
But there's no reason to believe now that we'll get a 10-year bear market like a la .com style, because they know the formula for getting out.
Just inject the bond market. Yeah.
And they're not going to not do that. And so I don't even know. To me, it's like that's what I was saying before. Like I don't want to short anything anymore. I just want to look for that correction and just buy. Why do anything other than that? It does. I don't even understand why do anything other than that. Just use options in order to monetize on the downside if that's what you're worried about, and then look for buying opportunities.
I'll agree with you. And I know we've had this discussion on a previous episode where I was showing the recovery times of the last several corrections. And like since 2000, our correction periods are faster and faster. COVID is like one of the fastest ones we've ever seen. Right. And if that continues to be the case, then I support your thesis. Buy when there's blood on the street like crazy and load up, because if corrections are going to be short-lived, then you're not entering negative territory for very long.
Why do you think that is? Like, is it something about like the dissemination of information on the internet, or like people are just moving on quicker?
I think I feel like there's a ton of reasons, but if I had to add a list of reasons to it, it would be we've made some major changes to the way that the Fed plays a role in the overall economy. And those changes include its ability to start buying bonds, even in the private sector. They usually were only able to issue well, I'm gonna have to be careful with my words here. I am not an economist, so I don't want to end up misspeaking here. But I do know that the Fed plays a major role here. That's part of it. The other part of it is that if we look at like the major correction in the .com bust, there was a huge price to earnings multiple. But the interesting part was that many of those companies weren't actually generating a profit. We've entered a different corporate cycle now where many of these companies are generating extreme profits, like insane, very, very interesting upside to their ability to generate real returns on equity. Even Tesla, for a long time, I was always like, I don't know what it is. It's a car company, it's a tech company, who knows? But they can't generate money. That's the biggest part of it. Like, they're a losing enterprise. And now they're making like $15 billion a quarter in earnings. So the difference, I think, now is that companies are looking pretty positive to their earnings side across the broad swath of companies that are in the S&P. And if that's true, then when you go to decide to buy something that's been discounted, what you're asking yourself is, do I think this company is going to continue to earn in the future, and will they be worth more in the future? If companies are still showing good earnings over the last several years, and you expect them to be able to continue to do so, then I think that continues to support the idea of just buying in. But that makes me wonder if it has a lot to do with not just the government's involvement in markets, but also people's perception of companies in the markets. If our perception is that these companies are still good, they're still going to earn money in the future, then it's worth continuing to buy.
It feels like in general, like at least on the retail side, not even just in trading and investing, but like we're moving on faster from things, like COVID. It happened, the Russian war. Like, it feels like these things happen and it sort of gives a little shock to the market, and then everyone just kind of forgets about it and moves on. And like that period of the dip caused by whatever news is just becoming shorter and shorter.
Possibly. And
Well,
then I
there's two
also,
things.
oh, sorry, I was just going to add like one more thing. The dissemination of information part is interesting to me because it kind of fits into the efficient market hypothesis concept. But I don't think all market participants are rational. There's a whole lot of noise that's in the market, a whole lot of just randomness. I mean, GameStop is a perfect example of complete irrational investment in a company that in general is a losing enterprise, and you're piling into it because it's a meme stock.
But it doesn't matter though, because of the connectedness of everybody,
Right.
and because everyone can kind of like they're all coordinating with each other, but they don't know that they're not like doing it on purpose. It just happens organically.
Sure. Well, if all of that's true, then that means that we could be seeing an increase in noise in the market that also contributes to a bubble that we don't recognize as a bubble until after the fact.
Yeah, something
It's
really bad would like something really really bad would have to happen. I guess it's worse than everything that has happened in the last 6 years.
Sure.
well, could anything? Because I don't think this could be anything. I mean, short of "Don't Look Up" coming into reality and the asteroid coming to Earth. Um, there's nothing that can stop government entities from debasing the currency, and so anything denominated in that is going to go up and to the right, even if the value is not actually there. But there's two things to add on what you were saying, Mike, there, because in a sense you were discussing this idea of these forced market participants. If the Fed is participating inside of it, they are a forced participant in a sense. But then you also have the passive investment flows.
Right.
So there's all this money coming into markets from
Roth IRAs, 401ks.
exactly that in no way are trying to make a determination if the stock is worth buying. There's no valuation idea or anything like that. It's part of the index, and so the money goes in. And so and there's something to be said for the fact that when we see these crashes occur, or these large market corrections occur, they occur around options expiry, like a lot of the time. The quarterly expiries in September, March, June, and January, February, depending on when you want to calculate it. But these quarterly options expiry ends up in periods where the volatility is no longer well supplied. The options that people have purchased in order to protect themselves against the downside, which makes it less likely that the price will move down because they are protected. Once that dries up, then an event, some sort of catalyst, can then cause the market to fall. But then when it falls, the options that then get created after that expiry is done, those calls end up going in the money way faster because it's harder to fall further if you don't have that reflexivity that causes the price to push lower. Essentially, when all the forced sellers have forced sold, then you only have buyers. The calls then end up getting going into the money way faster, and then the performance as they go up, the market makers have to keep on buying in order to offset the value of those calls, and so you get this rise back up really quickly because the gamma just causes a squeeze, and then people then chase the performance, and so it's sort of like there's too much buoyancy within the market because of the options space that makes it so that these crashes, I mean, they just can't occur. We have not seen it since 2008. They
I
just
do,
don't happen.
yeah, I do think that is a huge part of this, is just the diversity of market participants changing over time. I mean, there have been periods in the past in the stock market where people are vehemently opposed to participating in the market at all. My parents' generation were like, "Oh, the stock market's too risky. I'm never getting involved." And just be careful with your money there. Like, there's better things you can do. CDs are much better, better guaranteed return. Oh, really, mom and dad? Like, I don't think I'm getting very excited about 0.4% interest on my CD, right? Now it's a little different, with over 5% out there. But for years and years, there was not much of a benefit to the low risk, low return environment. But that's changed. In the last 20 years, I feel like the internet has created a whole lot of stock market gurus now, and lots more people that are interested in participating. And if that participation continues to increase, then yeah, I see that buoyancy unfolding in all of those markets, the stock market, the options market, futures, because it just creates more demand for participation and more volume in the markets. And collectively, hopefully, there's collective wisdom pushing it in the correct direction. If there's one thing I know is true in general, over the longest period of time, markets are always going to go up. We're not all going to like pile on and suddenly make a bet to the downside for very long. We all kind of get the sense that we're still investing in companies that earn real profits. So,
have you heard this idea that I think Michael Howe was talking about this from Cross Border Capital, where in Weimar Germany, during the inflationary period, the consensus amongst the adults, their boomer generation, let's say, was to buy bonds. Like, bonds
yeah,
were the safe
exactly.
asset,
Right.
and then the stock were not, and that the young people got into the stock market, and to them it was like that was like their crypto. And the older generation was like, "You're being ridiculous. You should put money in the bonds. It's safer." Blah blah blah. And then the bonds completely got destroyed, and the stock market zoomed. And it turned
Sure.
out that was, in a sense, the better bet. And there's an argument being made now that crypto is that new version now. That we look at it, oh, that's risky, and what are you talking about? That's not going anywhere. But the stock market is the bond market from Weimar Germany, and that we'll look back and go like, hey, those Pepe coins that you bought, that was really the best bet you could have made.
I know that's true when I hear people saying that, well, at least in the crypto market, Bitcoin is the more stable asset. And I'm like, whoa, hold on a
Stable.
second. We got to a point where Bitcoin is suddenly not that volatile anymore, even though it's
Suddenly
significantly more volatile. Exactly.
Yeah, very true.
I mean, it is less volatile now than some of the meme stocks. Like, I think it's stabilized.
No question. But I think
compared to years ago.
It highlights people's appetite for risk now. Their understanding and comfort with volatility is different than I think it was 20 years ago. A 5% correction in the S&P 500 was like a heyday for the news, and now we're getting to a point where it's like, well, 20%. All right. Now I'm getting a little worried.
It's so much easier too, and like you can do it with a smaller amount of money, and like because you can just open up your Robinhood app and like a few clicks, you can play with $500. Like, that was impossible. I mean, a broker wouldn't give you the time, or they would give you the time of day, but it would just take longer to do it. The process to get set up and everything was just a lot more complicated.